Welcome back to the deep dive.
Mm.
I am genuinely excited for this one because, frankly, we are going to do something a little bit different today.
Yeah, bit of a pivot.
Exactly.
Yeah.
Usually, we take a really wide look at a big topic, macro stuff. But today, we are zooming all the way in.
Way in. Microscopic.
We are taking a microscope to a very specific, very painful moment that I think every single person listening to this has felt.
Oh, I know exactly where you are going with this. It is a universal experience in this game.
You know the moment. You are sitting there, you've done the work, you spent the whole morning analyzing the news, you are checking the levels, drawing your lines.
You have your whole thesis ready.
Right, you have the thesis.
Yeah.
You are staring at the chart, and then you see the price start to move.
Yeah.
And it looks fast. It looks really urgent.
Your heart rate spikes a little bit.
It totally does.
Yeah.
You think to yourself, this is it. This is the breakout I've been waiting for. You click buy, and almost the millisecond your order fills.
The reversal.
It just rips against you.
It always does.
It does not just drift down either. It spikes down. It is violent. You get stopped out almost instantly.
Flipped right out of the market.
And you are sitting there furious, feeling like there's a hidden camera in your living room. And some hedge fund manager is just laughing at you personally.
Sweating bullets.
Yeah, and this is the absolute worst part. 5 minutes later, the market turns right around and goes exactly where you thought it was going to go in the first place.
The classic stop hunt. I mean, it is without a doubt the most frustrating, demoralizing experience in trading.
It really is.
It feels personal because it exploits your human nature. It exploits your fear and your greed simultaneously.
It feels incredibly personal.
Yeah.
But here is the good news. What we have in the stack of research today, specifically this fascinating text called the Candle 3 excerpt, is essentially a guide on how to stop being the victim of that exact move.
Yes, it is a survival guide, basically.
It is a guide on how to stop funding the market's liquidity and start being the person who actually rides the real move. We were talking about the Candle 3 phenomenon today.
Right. And if we had to boil this entire deep dive down to a single bumper sticker or maybe a tattoo for your forearm, it would be this thesis. If Candle 2 is the lie, Candle 3 is the truth.
If Candle 2 is the lie, Candle 3 is the truth. I like that. It sounds almost philosophical, like we were in a Matrix movie or something.
It does sound a bit sci-fi, but we are talking about hard money here. We are talking about your P&L.
Exactly.
We are talking about pure market mechanics. You see, the market is an engine, and like any engine, it needs fuel to run.
And that fuel is money.
That fuel is liquidity.
Yeah.
Your orders, my orders, the listeners' orders, the sources we have today paint a very specific, a very clear picture. The market constantly deceives traders because it absolutely has to.
It has to trick you.
It needs to trick you to get your liquidity so it can actually move. But there is a specific moment, a split second in the market structure where the deception just stops. The lying stops. And the market just goes.
A moment of truth.
Exactly. That is the moment of truth. And that is the mission of this deep dive today. We want to dissect that exact moment.
We want to move you, the listener, from the person gambling on the trap, which is Candle 2, to the person executing on the absolute certainty, which is Candle 3.
Right, because it is about shifting your entire paradigm.
And before we get into the weeds here, I want to clarify something for the audience. We aren't just talking about spotting a green bar on a chart or a specific candlestick pattern like a doji or a hammer. This is about understanding institutional intent, isn't it?
It is the shortcut to understanding institutional intent. That is the perfect way to phrase it, actually. When you understand why Candle 3 exists, you stop looking at charts as just random lines or chaotic wiggles.
You stop thinking the market is just random noise.
Exactly. You start seeing a narrative. You see the setup, you see the trap, and then you see the expansion. And that expansion, that Candle 3, is where the profit lives.
So let us unpack this narrative. We have got a lot to cover today. The anatomy of this perfect candle, why it is mechanically safer to trade, and the psychology of why, paradoxically, it is the scariest candle to trade in real time.
It's terrifying in the moment.
But let us start with the narrative arc. You mentioned this 3-act structure of price earlier. Walk us through that.
So imagine a play or a movie. You cannot just jump straight to the climax, right? You need the setup.
You need the exposition.
Exactly. In the market, this plays out in 3 distinct phases, or 3 acts. Now, a quick disclaimer on the word candles here. We could be talking about 3 days on a daily chart, 3 4-hour periods, or even 3 15-minute periods.
The fractal nature of the market, it applies everywhere.
Right, the logic holds up regardless of the time frame. But for our visualization today, to keep things simple, let us just picture 3 sequential events or 3 candles on a chart.
Okay, so Act 1, the curtain rises. What are we looking at?
Act 1 is consolidation. We will call this candle 1. This is the calm before the storm. The market is confusing here. It is choppy.
Prices are just bouncing back and forth.
Bouncing in a tight range with really small bodies. There is no clear direction.
This is when you are staring at the screen and you were just bored. Or maybe you were unsure. You were trying to force a trade where there really isn't one.
Bored or frustrated. Yeah, you are trying to draw trend lines, but they keep getting broken by a couple of pips. The ranges are small. There is no real energy yet.
It is just coiling up.
It is coiling. Think of a spring being compressed down. That is candle 1. It is establishing a baseline. But critically, it is inducing traders to place orders on either side of that range.
Inducing them how?
Well, people are looking at that tight range and they are putting buy stops above the range and sell stops below the range. They're looking at it and saying, if it breaks out of this box, I want in.
They are setting the trap for themselves. They are laying out the liquidity that the institutions are going to come for.
In a way, yes. They are providing the potential fuel. And then comes the villain of the story, Act 2.
The villain, I like that.
Act 2 is the trap. Candle 2. This is the manipulation phase. This is where the market actively lies to you.
So what does that look like?
Suddenly, out of that boring, tight consolidation, price just rips. It moves sharply in one direction. Let us say it drops. It looks incredibly urgent. It breaks a support level that everyone has been watching for the last hour.
And this is where the FOMO kicks in, right? See that breakout, you think, oh, finally, it is moving, it is crashing. I have to get in short right now.
Precisely. It induces fear and urgency. If you are already long, you are scared you are wrong, so you sell to close your position.
Taking a loss.
Taking a loss. And if you are on the sidelines, you are scared you are missing the big move, so you jump in short.
Adding more fuel.
Adding more fuel. But the key characteristic of candle 2, the lie, is that it is designed specifically to trigger those stops. It sweeps the lows of that consolidation specifically to collect that liquidity we just talked about.
It feels different though, doesn't it, when you were watching a trap form versus watching a real move?
It does feel different, and this is a nuance that really takes screen time to develop. It feels nervous, it is jerky, it spikes down, it pulls back a bit, it spikes again.
It is trying to do too much.
It is designed to look like a breakout, but it is actually a search and destroy mission for stop losses. It feels thin, like there is no real weight behind it.
So everyone piles in thinking this is the big move. They're selling into the hole. But it is not the move.
No, it is not. It is just the fuel collection phase. The market has now grabbed the orders it needed. It has filled the huge institutional buy orders by inducing the retail traders to sell.
Wow.
And that brings us to Act 3, the truth. Candle 3.
The hero of our story today.
The expansion candle. After candle 2 has swept the stops and completely trapped the retail traders, candle 3 appears. And it moves in the exact opposite direction of candle 2.
The reversal.
The real reversal. But here is the major difference. It does not hesitate. It does not bounce around. It moves with what the source text calls authority.
Authority. I really like that word in this context. It implies it is not asking for permission. It is not checking to see if anyone agrees with it.
It isn't asking at all. Candle 3 is the market saying, okay, I've collected what I need. I have the liquidity. Now here is where I am really going.
And this shift, this moment of truth is palpable, isn't it?
It is incredibly palpable. If you have been trading for a while, you can actually feel the difference in the tick data.
How so?
Well, candle 2 feels erratic, like we said. But candle 3 feels heavy. It feels inevitable. It is like a freight train leaving the station. It just chugs along and picks up speed.
It is like the difference between someone bluffing in poker, they're sweating, twitching, overbetting, and someone just calmly slamming down a royal flush.
That is a perfect analogy. Candle 2 is the bluff. Candle 3 is the reveal.
And the tragedy of the retail trader is that they usually fold on the bluff, they get stopped out on candle 2, and then they have to sit there and watch the royal flush play out while they're on the sidelines.
Totally paralyzed.
Paralyzed because they just took a loss on the fake move. They don't want to get hurt again.
Exactly. So our goal today is to get you to stop folding on the bluff and start betting on the royal flush. We want to align you with the house, not the gambler.
We want to stop you from being the liquidity and start you being the operator.
I love that. So let us dig deeper into identifying this authority.
Let's do it.
You mentioned you can feel it, but for the listeners who are strictly technical, the ones who want the hard checklist, who want to be able to code this into their brain or their algorithm, what are the hard signals? How do we differentiate candle 2 from candle 3 visually?
Right, because in the heat of the moment, a red bar is a red bar and a green bar is a green bar? It is a great question because visual recognition is everything when you only have seconds to decide.
So what is the checklist?
There are 3 pillars of confirmation outlined in the material. If you see these 3 things, you are very likely looking at an expansion candle, not a trap. The first one is straightforward.
Right.
Range explosion.
Bigger is better.
In this specific context, yes. But it is relative. You have to compare it to the recent history on the chart.
Relative to Act 1. Exactly. If your average candle in the consolidation phase, candle 1 was, say, 20 pips, and candle 2, the trap, was maybe 35 pips, candle 3 is going to be 50, 60, maybe even 80 pips. It dominates the chart. It is the elephant in the room. You literally cannot miss it. Right. The sheer size difference is the first signal of intent. The market is expending a massive amount of energy to move price from point A to point B.
It wouldn't do that if it were just testing a level.
No, it wouldn't. It is doing that because it has a destination. It tells you this is real. It is basically the market shouting its intentions.
Okay, so pillar 1 is range explosion. What is pillar 2?
Pillar 2 is clean structure, and this is where you have to talk about wicks. In the source material, there is a heavy emphasis on understanding the story the wicks are telling.
The wicks being the little lines above and below the solid body of the candle.
Right, the highs and lows. Think about what a wick physically represents in the market. If you have a candle that goes way up but then closes back down near the bottom, leaving a really long wick at the top, what physically happened there?
Buyers tried to push it up, they ran into a wall of sellers, and they got smacked back down. It is a rejection.
Exactly, rejection, struggle, uncertainty. That is typical of candle 2. The trap often has long wicks because it hits a level, grabs the liquidity, and then immediately recoils.
It hits the wall and bounces off.
But candle 3 has a clean, strong body. It opens, it drives, and it closes near the extreme.
So if it is a bullish candle 3, it opens near the bottom and closes near the very top. No wick on top.
Minimal to no wick at all. A long wick at the top of a bullish candle means sellers stepped in and fought back. Candle 3 shows absolutely no struggle.
It just glides.
It shows that price is being allowed to move. There is no one standing in its way. That is what we mean by clean structure. It looks like a solid block of color on your chart. It shows pure conviction.
That makes a lot of sense. And pillar 3?
Pillar 3 is speed and momentum. This is the time factor. Candle 3 forms quickly. It does not grind.
It doesn't take 3 hours to move 10 pips.
No, it rips. It covers ground fast.
Why is speed so important here? Why can't a real move just be slow and steady?
Because speed tells you that institutions are actively facilitating the move. They aren't restricting it, they are pushing it.
The big money is moving.
Right when the big banks or the algorithms want to reprice a currency or a stock, they do not dilly-dally, they execute. They have massive orders to fill, and they want to fill them right now.
So if I see a candle that is big, clean, and forming really fast,
you are seeing institutional footprints, plain and simple.
So let us visualize the perfect candle 3 sequence for the listener.
Okay, so picture this in your head. You see a chalky consolidation range. That is Act 1. Boring.
Boring tight range.
Then you see a sharp move down. That is candle 2. It sweeps a previous low, maybe triggers a bunch of stops. It looks really scary.
Everyone is panic selling.
But then almost immediately the next candle opens. It opens right where that manipulation ended, and it just starts climbing.
No hesitation.
It climbs past the open of candle 2. It climbs straight past the entire Act 1 consolidation. It creates this massive green body.
Just a giant green block.
And it closes at the very high of the session. It is twice the size of anything else on your screen. That sequence right there is the moment of truth.
And that is where the money is.
That is where the money is. Because that candle isn't asking any questions, it is answering them.
I want to circle back to something you touched on just a minute ago. The why. Why does candle 3 move so fast? You mentioned it earlier, like there was no one standing in its way.
Yeah.
The source text uses this snowplow analogy that I thought was absolutely brilliant.
Oh, the snowplow analogy is fantastic.
I think really understanding this mechanical aspect is what separates the pros from the amateurs.
I agree completely. It is the best way to understand the actual mechanics of liquidity. I think this is the light bulb moment for most traders when they finally get this.
So break it down for us.
Think of liquidity, which is all the resting orders in the market like snow on a road.
Okay, I am picturing a road. A massive blizzard just came through. Several feet of snow on the ground.
If the road is covered in deep snow, which represents the buy limits, the sell limits, the stops, all of that friction, a car trying to drive down that road is going to get stuck.
It can't go anywhere fast.
It is going to spin its wheels. It cannot move. That is Act 1. That is your consolidation. The orders are stacking up on both sides, creating massive friction.
So the market can't really move because there are just too many orders in the way.
Yeah.
It has to transact with every single one of them to push through.
Exactly. It has to chew through all that paper. For the price to go up, it has to buy from every seller at 10, then every seller at 11, then 12.
That sounds exhausting for the market.
It takes time. If there are 1,000 sellers at 11, price stalls there. Now enter the snowplow.
The snowplow is candle 2.
Yes, candle 2 is the plow, the manipulation. When candle 2 rips down and sweeps those stops, that big wall of stops acting as resistance, it is effectively the plow scraping the street clean.
Wait, slow down a second. Explain that part again. How does moving down clear the road for the market to eventually go up?
This is the real magic trick of the markets. When price drops hard during candle 2, it triggers the stop losses of all the retail people who were long.
Right, their safety nets get hit.
But what is a stop loss for a long position? Technically speaking, it is a sell order. The market executes a sell to get them out.
Okay.
The institutions use all those triggered sell orders to secretly fill their massive buy orders. They absorb all that selling pressure in one swoop.
Wow, so they are buying the panic.
They are buying the panic, they clean out the order book, so they get their position filled at a great price.
So it literally clears the path. It pushes the snow to the side.
It completely deletes the counter pressure. Once candle 2 has finished its job, the road is completely clear. The sellers are gone because they all just sold to the institution during the trap.
They have no ammo left.
None. So candle 3 is the sports car driving down the freshly plowed highway. There is absolutely nothing left to stop it. That is why it moves so far and so fast.
That makes so much sense. Because the stops that were acting as potential friction have already been triggered. They are gone. The order book is entirely thin on the way back up.
Exactly. They have been absorbed. The resistance has been removed by the trap itself. So when the real move starts, it faces zero friction.
It is like running through an empty hallway versus trying to run through a crowded nightclub.
Perfect way to picture it. Candle 3 is the empty hallway. And this actually leads us directly into a more technical confirmation that connects to this idea of speed. Fair value gaps.
FVGs. We hear about fair value gaps constantly in modern trading circles.
Yeah.
It is a bit of a buzzword on social media right now.
It is everywhere, yeah.
How do they fit into the Candle 3 narrative specifically?
An FVG is essentially the physical footprint of the snowplow working perfectly. It happens when price moves so fast that it literally skips levels on the chart. It creates a literal gap in the pricing delivery.
Can you visualize that for us? How do I spot an FVG in this specific 3-candle sequence?
Sure. Imagine a 3-candle sequence, let us say, on a 5-minute chart.
Okay, I am with you.
Candle 1 makes a high. Let us say the high is at 1.1050.
1.1050.
Got it. Then candle 2 is a massive expansion candle moving up. It is a huge green bar. Then candle 3 forms, and the lowest point it reaches, its low, is at 1.1055.
Okay, so the high of the first candle was 50, and the low of the third candle was 55.
Exactly. There is a 5-pip gap between the high of candle 1 and the low of candle 3. That empty space on the chart where the wicks do not overlap, that is the fair value gap.
And that gap means what exactly? Why does it matter that price didn't overlap perfectly there?
Think of painting a wall with a roller. If you move the paint roller slowly and carefully up and down, you cover every single inch of the wall.
Nice even coat.
That is efficient pricing. That is a normal balanced market. But if you swipe the ruler incredibly fast because you are in a massive rush, you might skip a spot entirely. You leave a blank gap on the wall.
Ah, I see. So the gap is a sign of extreme haste.
Exactly. An FVG means the market was so one-sided, so aggressive in its intent to reprice higher, that it didn't even bother to offer price at those intermediate levels.
It just teleported past them.
It signals raw institutional power. There was no time for normal two-way price discovery. The buyers just overwhelmed everything instantly.
So if I am sitting there seeing candle 3 form, and I am seeing these fair value gaps leaving these pockets of empty space behind on the chart, that is my green light.
That is the ultimate green light. It confirms that you aren't just looking at a random volatility spike. You are looking at a true repricing event.
The market is on a mission.
The market is in a huge hurry to get somewhere else. If FVGs are forming, you stay in the trade. It confirms high momentum and really strong institutional participation.
It is the market screaming, I have unfinished business at a much higher price.
That is exactly what it is saying.
Which brings us to the hard part, the really, really hard part.
A holding.
The holding. We can sit here and talk about how perfect candle 3 looks on a PDF or a slide deck, but when you are sitting there alone in your room, sweating, watching your P&L fluctuate by the second, is totally different.
It is a different beast entirely.
Let us talk about the psychology of this, because knowing what it is and actually trading it are worlds apart.
The psychology of candle 3 is fascinating because it deals with what I call the hindsight trap.
Oh man, I know this one well. The old I knew it feeling.
We all do. When you look at a chart at the end of the day, candle 3 looks incredibly obvious. You see the consolidation, you see the trap, you see the massive expansion.
Will slap your forehead.
You say, of course it was going up. Look at that massive green candle. Why didn't I buy? I'm an absolute idiot. It was right there screaming at me.
It is always so clear in hindsight.
But in real time, it is terrifying because in real time, you are still suffering from the emotional trauma of candle 2.
Right, you just got burned.
You just saw the market rip down. You might have just taken a very real financial loss on that trap. You are confused.
Your confidence is shot.
So when candle 3 starts to move back up, your brain is screaming at you. Is this just another fake out? Is this just a tiny pullback before we go even lower?
You are just waiting for the other shoe to drop. You do not trust the market anymore because it literally just lied to you 5 minutes ago.
Exactly. You have PTSD from the last 5 minutes of price action. And then once candle 3 really gets going and it is up 30 or 40 pips, a brand new fear unlocks in your brain.
Which is?
It is too high. I cannot buy now. I missed the perfect entry.
Oh yeah. I am chasing. If I buy right now, I am going to be the sucker who buys the absolute top.
Right. So you have fear at the bottom telling you it is a trap. And you have fear in the middle telling you it is too late to enter.
That is paralyzing.
This is exactly why most retail traders completely miss candle 3. They're paralyzed by the transition from the lie to the truth. They just watch it happen.
So how do we break that paralysis? Because the source text says something very reassuring here. It says, you do not need to be perfect.
And that is the absolute best news in this entire outline. You do not need to catch the absolute bottom of the wick on candle 2.
You don't need to be a sniper.
You don't even need to catch the very start of candle 3. If you identify the authority, that range explosion, that clean structure we talked about, halfway through the candle, there's still plenty of room for profit.
Because candle 3 is huge.
Because it is an expansion. It is going to run. It has massive inertia behind it.
So entering late on a candle 3 is actually better than entering early on a candle 2.
1,000 times yes.
Yeah.
Entering late on the truth is infinitely better than being early on the lie. I would rather lose the first 20% of the move to gain the absolute certainty of the next 80%.
You pay a premium for certainty.
You pay a premium for certainty, and it is worth every single penny.
That is a quote for the wall right there. Pay a premium for certainty. No. But let us talk about the other side of the psychological coin. Not entering, but exiting too early. The source mentions a really painful scenario here. You catch the move, you overcame the fear, you are in, you're up 30 pips, and then you just bail. You close the trade.
And then you watch it run another 70 pips without you.
Exactly. Why do we do that?
I call it the eating like a bird syndrome. Taking tiny crumbs when the market is literally offering you a whole loaf of bread.
Where does that come from?
This stems directly from a scarcity mindset. Your human brain treats unrealized profit, that open green P&L on your screen, as money that is already safely in the bank.
Even though the trade is still open.
Right. So when you see you are up $300, you mentally spend it. You buy the groceries, you pay the phone bill in your head.
And then the market naturally ticks down a bit, and now it is only up $250.
And you feel like you have been robbed in an alleyway. You feel a massive psychological loss. You think, I just lost $50.
But you didn't.
No, you didn't. The trade is still open and wildly profitable. But to protect that imaginary money, you just closed the trade. You take the $250, and then the market rips to $1,000.
That hurts more than a stock out sometimes.
Yeah.
It really, really does.
Yeah.
It feels like you betrayed yourself.
It does, because it validates that your technical analysis was completely right, but your psychology was horribly weak. It tells you that you aren't mentally ready for the big wins yet.
So how do we fix that? The text discusses a required mental shift.
You have to forcibly move your mindset from protect profit before it disappears to this profit isn't mine until the trade actually closes.
That is hard to do.
And viewing pullbacks differently, right?
Yes. In the old retail mindset, a pullback immediately means reversal. Get out now. In the candle 3 mindset, a pullback is just normal noise inside the expansion.
It is just the market breathing.
Exactly. Unless the actual candle structure breaks the trade is completely valid. You have to learn to tolerate the discomfort of seeing your profit dip temporarily, those paper losses, to actually get the big payout at the end.
It is the classic marshmallow test for traders.
It really is. Can you sit there and wait for the second marshmallow? Because candle 3 offers the whole bag of marshmallows if you can just manage to sit on your hands.
Okay, let's get really practical now. We have covered the theory, the mechanics, and the feelings. Now I want the instruction manual. How do we execute and manage this trade? The outline specifically mentions a rule for staying in.
Right. We need to take human emotion completely out of the exit strategy. When emotions go up, intelligence goes down. That is a fact.
So what do we replace the emotion with?
We use candle structure instead. It is totally binary. It is not about how you feel, it is about what the candle actually looks like on the screen.
Okay, so what is the signal to hold? I am in the trade, my heart is racing. What do I look at to tell me to stay put?
You hold the trade as long as you see expansion structure, period. Large range candles continuing in your direction.
Big bodies.
Big bodies, closes near the extremes. Minimal wicks on the side of your trade, each candle pushing further than the last one.
So if I am long and every single 5-minute candle is closing near its high, I just do nothing.
You do not touch that exit button. You are surfing a massive wave. You do not voluntarily jump off the surfboard while the wave is still actively pushing you forward.
Okay, but when do we consider jumping off? When does the wave finally break?
When the character of the price action changes, you look for 3 specific things. First is range contraction. The candles start getting noticeably smaller. The energy is drying up.
The momentum is fading.
Second is rejection. You start to see long wicks appearing in the direction of your trade.
So if I am long, I start seeing big wicks on top of the candles.
Exactly. That means sellers are stepping back in and fighting. And third is if price really struggles to make new highs, if it stalls out at a level and just goes sideways.
That is when you exit.
That is when you exit. Not because you are scared of losing your profit, but because the structure clearly told you the party is ending. You exit on technicals, not on your P&L fluctuating.
What about stop losses? Because riding a really volatile expansion can be tricky. You don't want to get shaken out by a random whip in price, but you also desperately want to protect your gains.
The sources suggest 3 specific trailing methods. They range from aggressive to conservative. You really need to pick the one that fits your personal risk tolerance.
Let's hear it. Method 1.
Method 1 is candle by candle.
How does that work in practice?
This is for the adrenaline junkie who wants to lock down profit fast. As soon as a new expansion candle fully closes, you move your stop loss directly behind the low of that previous expansion candle, assuming you are long, of course.
So you're basically locking in profit every 5 minutes or whatever the time frame is.
Yes. It keeps you securely in the trade as long as the expansion holds its aggressive structure.
That sounds pretty safe.
It is aggressive profit taking. If the market turns sharply, you are out instantly. It guarantees you keep a good chunk of the move, but the downside is you might get clipped out on a slightly deeper pullback before it continues higher.
Okay, that makes sense. What is method 2?
Method 2 uses those fair value gaps we talked about earlier. We call it FVG protection. Remember, we said an FVG acts as a zone of support, right?
Right, because it is empty space. The market just skipped over.
The market really shouldn't want to go back deeply below that gap if momentum is truly real. So when FVGs form on the chart, you place your trailing stop within or just below that fair value gap.
That feels a bit more, institutional.
It is. You are using the market's own algorithmic structure as your shield. You are essentially saying if the market fills this huge gap and keeps going down, then my overall thesis is wrong anyway, so take me out.
I like that one. And method 3?
Method 3 is range-based. This is the most conservative. If the average range was 20 pips and your expansion candles are running 40 to 50 pips, you just keep your stop 1.5 times the average range behind the current price.
So 30 pips back.
Exactly. It gives the trader plenty of room to breathe. It leaves room for normal market noise, but it still totally protects you from a catastrophic full reversal.
So you use these trailing methods to just ride the wave as far as it goes.
Mm-hmm.
And this brings us to the math of it all. The concept the text calls multiple R.
Ah, yes. Multiple RR is just your initial unit of risk.
So if I risk 20 pips on a trade to begin with, 1 R is 20 pips.
Correct. The ultimate goal of trading candle 3 is not just to get a win, it is to get a huge win. 3R, 4R, 5R.
Making 3 to 5 times what you risked.
Exactly. And the magic of that math, the positive expectancy, is that if your winners are consistently 3 or 4 times bigger than your losers, You only need to be right 35 or 40% of the time to make an absolute fortune.
You can literally be wrong more often than you are right and still be highly profitable.
You can be wrong constantly and still get rich. But, and this is a massive but, this mathematical advantage is totally impossible if you exit the trade at the very first sign of a pullback.
If you take 1 R every time, you never get the big math to work for you.
Never. You will never get those 3 R plus wins. You have to let candle 3 do the heavy lifting for you.
That takes so much pressure off the need to be perfect. You don't have to predict every single wiggle on the chart.
It really does. You stop trying to be a fortune teller predicting the future, and you start being a strict risk manager. You stop trying to be right on every trade and start trying to just be profitable over 20 trades.
Those are 2 very fundamentally different things. Being right versus being profitable.
Completely different mindsets.
Before we wrap up, I want to touch on one more really cool concept from the outline. The multiple expansion bonus.
Oh yeah, this is when the stars really align. Sometimes candle 3 isn't just one single candle. Sometimes the institutional move is so incredibly strong that you get multiple massive expansion candles in a row.
Back to back to back.
The first one breaks out and establishes the new direction. The second and third just violently continue the momentum.
That is just a straight up trend being born.
This is the ideal scenario for a trader. It means there is serious, heavy institutional backing that is positioning for a long-term trend. When you see multiple expansion candles forming in sequence, your job is wonderfully simple.
Do nothing.
Stay in the trade, just sit there, do not exit early. The market is basically handing you a megaphone and telling you it wants to go much further. This is the birth of a trend.
Okay, let us bring it all home now. We've gone from the frustrating confusion of Act 1 and Candle 1 right through the painful lie of Candle 2.
The trap.
The trap. And finally, to the truth and the authority of Candle 3. We have talked about snowplows, clearing the liquidity. We talked about wicks and fair value gaps.
We covered a lot of ground today.
We really did. If we had to sum this whole deep dive up, what is the one single thing the listener absolutely needs to take away from this?
It is the realization that clarity always comes after the fact, but the actual profit comes from recognizing authority in the moment. You have to train your eye over time to see the visual difference between nervous jerky price action and authoritative heavy price action.
Trust the weight of the candle.
Trust the weight. When you see that clean body, that massive range explosion, that incredible speed, that is the market extending a hand to you and saying, come with me. I cleared the road.
Take the hand.
Take the hand and hold on.
I love that. And I will leave you all with a final provocative thought today. A challenge for you, really.
Oh, a challenge. I like it.
Go open up your trading journal. Look at your last 10 trades. Specifically, look at the ones you lost money on. Ask yourself honestly, did you buy Candle 2? Did you buy the manipulation trap?
Ouch. That is going to hurt for a lot of people to look at.
It is a painful audit, but look at the ones where you took a tiny profit too. The ones where you took 20 pips and ran away. Did that exact trade turn into a massive Candle 3 expansion that went 70 or 100 pips without you?
A very necessary audit, though. You have to face the music.
You really do.
Oh.
But once you see this 3-act structure on your own charts, you really cannot unsee it. Candle 3 is where the life-changing profits are made, but only if you have the discipline to trust the structure over your own fear. Well said.
Thanks for diving in with us today. We will see you on the next one.
Trade safe out there, everyone.
And seriously, stay clear of the snowplow.